Hi everybody, it's Paula Rojas, Managing Director of Synergy Resource Capital, and welcome to the weekly by Synergy. 5-minute musings on the markets, current trends, and events. From our opinions, observations, analysis, and news commentary, just a few lines or minutes if you're catching this on video to get you started every week. Let's go! This week's commentary is centered around lithium investing in Australia. Mining companies have been roughly about 30% of listed entities on the ASX, at least since we started tracking them back in 2014. This makes materials the most crowded sector in the exchange, translating into 674 companies. A growing number of these are focused on lithium, the chemical element that underpins the electric vehicle revolution. We routinely talk about lithium, having worked in the space for over a decade, so let's look into this. Weekend pricing kept miners at stress levels for a while in recent years, with some unfortunate mine closures. This is not the first time a lithium bubble has burst. Lithium had a boom in 08-09, only to plummet shortly after and resurge in 2015-16, to then calm down again in 2018, and now it's booming. Already popular with retail investors, perhaps due to the ESG qualities, lithium has remained a tough niche for institutional investors to deploy capital. Pricing has been controlled by party-to-party contracts, and an easy way to hedge just doesn't exist. This is coming to an end in June 2021, with the LME finally releasing its much-anticipated new cash-settled lithium futures contract, settled against Fast Market's price assessment for lithium hydroxide monohydrate. Behind the current sentiment lies the fact that lithium-ion appears poised to remain the core battery tech platform for the foreseeable future. We are contrarian investors by conviction, so downturns are times to find hidden gems and get positions. Bubbles are trickier times to enter or average down your costs, requiring deeper analysis to identify company-specific opportunities, such as low valuations in comparison to peers, little to no additional value assigned to new acquisitions, and upcoming exploration results, among others. As with most minerals and metals, we would suggest a diversified strategy, holding a variety of sources, hard, rock and brine, and even types of deposits and chemistry, extraction processes, traditional versus direct extraction, and others that may come up in the future, so keep an eye on technology, and of course metallurgy when appropriate. And finally, jurisdictions to diversify geopolitical risk and supply chain restrictions. Additionally, include a mix of producers, developers, and explorers to equalize the need for dividends and potential upside. So even though volatility may remain for some time, signs point to expansion, and we remain bullish. Lithium will continue to grow. Are you in? Stay tuned for part 2, where we will discuss some exciting ASX-listed lithium plays. In parts 3 and 4, we will cover TSXV and other exchanges. And that is it for today. We'd love to hear your thoughts. Reach out on our social media channels to chat, and if you found this useful, please like, subscribe, and share. You can visit our website to find additional resources for research in this particular topic. You'll find those links below. See you next week.